Christina. I'm a nerd, I'm a geek, I'm a data scientist, computer science graduate. I've run a technology company for 14 years, had a terrific exit, and I got into real estate because I realized that it's not about how much money you make, it's about how much money you keep. I had the big fat tech salary and I had the big fat tech bonuses, and I was working 14 hours a day. And I had a boss. He was generally a nice boss, but whenever I wanted to cut back, he would say, I could always pay 2 people what I'm paying you. That was the only nasty thing that he ever said. And that kept me in the rat race, kept me wanting to work 13, 14 hours a day. And I knew that at some point I wanted that freedom. But when I started with real estate, it was just to save on taxes. Most people here, they start in real estate with a fix and flip or a private lending, initiative, or maybe they get a single family rental. My real estate journey started in reverse. In 2003, I walked into my boss's office. He was a senior partner in the firm. I was a junior partner, and he was furious. And I could just look at him and say, Paul, what happened? He had just been insulted by our landlord, which happened to be General Motors in Fremont, California, the home of Tesla. So that's where we were headquartered. And he said, Neal, we are not going to be tenants anymore. We want to be our own landlords. And I said, that's great news. And he said, we are going to build our own campus. And I said, that's great news. And he said, and you are going to build it. And I peed in my pants right away because I knew nothing about real estate. I knew nothing about new construction. Luckily, he assigned a retired general contractor to me as a mentor. And that guy, even then, I made dozens and dozens of mistakes. But between 2003 and 2004, I ran a company with 400 employees, and in the evenings, built a campus from scratch, 30,000 square feet, big campus. Actually, if you're in the Bay Area and you're on Fremont, you will see freeway signs that point to that campus. And I was a partner in that campus. And before that campus was built, I was paying as much as 53% of my salary in taxes. That's what happens when you reach a certain threshold in Taxifornia. After I built that building, and then I ended up building another 6 of them because that pole vaulted our business to the next level. So it was a custom-built campus for our needs. And I ended up paying no taxes. People often talk about Donald Trump not paying taxes. My answer is, I'm not a fan of Donald Trump, but he's simply using the tax system. There's no reason why he should have paid more taxes because he's simply using the tax system, right? I haven't paid anything that I can recollect in taxes in 10 years. And when you become a general partner or GP, it's extremely likely that you will pay taxes for a very long time. And that allowed me to gather a huge amount of money in the 2005, 2008 timeframe. I didn't know enough about real estate, so I didn't invest. So my timing was really good. Around 2008, 2009, prices started to crash, and I started to do a lot of math. So my major is data science. So I would basically start looking at the math around real estate, and I would go around asking people. I'd never bought a single family rental or anything like that. I'd go around asking them, why is this not a good time to buy real estate? Everything was cheap, right? And I would get answers. Everyone would basically tell me why it was a horrible time to buy real estate because prices would go down further because they were already going down. And I said, why does that matter at all? Right now, when I buy these, I'm going to make a huge amount of money by renting them out. And they said, yes, but the price could go down further. And I realized that most people are actually extraordinarily irrational. So I stopped listening to people. My family banned me for 2 years from coming to family events because they thought I would infect all of the other kids in the family with buying real estate. I bought 1 home a month for 2 years straight. It required an incredible amount of time because remember, I still had the job of running a company with 400 employees, working 12, 13 hours a day. So Saturdays and Sundays, I would drive out. And I became obsessed with this idea of figuring out the best place in California. Back then it was California because driving radius, right? I didn't really understand that I could go out and buy stuff in Nashville or Orlando. I became obsessed with the idea of
Where in California should I be buying, right? And I would go around asking people, and the answers that I would get would be very subjective. This person would be like, I like Chico, and this person would be like, I like Los Angeles. But they wouldn't really explain why Chico was better than Los Angeles or Los Angeles was better than Chico. So I figured out I had to find a way of measuring this data. And I'm a data scientist, so it came naturally to me. So I hired a Ukrainian hacker. That's what everyone does. And the Ukrainian hacker hacked Zillow and Trulia and the Bureau of Labor Statistics website. I did receive a notice from the FBI because we were mining the website too fast and it crashed. Luckily, they didn't do anything about it, so that's I'm thankful for that. Otherwise, you might see interesting things on the internet about me. So the Ukrainian hacker gives me all this data, and I'm gathering this data about everything that I can think of: schools and income and jobs and home price increases and construction supply. I'm looking at every piece of data because I'm just going to gather data. I'm so greedy about it, and I gather in a software called R. Does anyone here know a software called R? All right. So you know the power of this software, right? You can basically put data into a software, and if you know how to do it, you can ask it to create correlations. So I was trying to create correlations, right? Is the highest correlation between school quality and profit? Or is it between income and profit? Or is it jobs and profit? What correlates the most to real estate profit? That's what I was trying to see. And once I got a correlation, a very high correlation, then guess what I would do? I would back test it. Right? Because maybe there's a statistical correlation between schools and profit, and it's a 96% correlation. In my world, the world of R, 96 is an amazing number. Basically, you know that this works, but then you've got to back test it. So for several years, I started to take the data and back test it by looking at different cities in California and also looking at different cities across the US. I wasn't ready to invest in them, but I looked at them. And I came to the conclusion that the city that had the highest correlation was a tiny city that I'd never heard of called Madera, California. Madera, California, 20 minutes from Fresno. So I jump into my car, I drive 144 miles, and I go to Madera. And I go into Madera, and I have a broker, and the broker's showing me all these properties, and there's entire streets of properties that are completely empty. And they're brand new, 2 4-bedroom homes built by Kaufman and Broad, and they're completely brand new. And they're like entire streets are empty because guess what had happened? In 2006, Kaufman and Broad wanted to sell a bunch of these. So they called a bunch of farm workers and said, there's this broker over here that doesn't require you to basically stated income. These are all farm workers, and you can go buy these homes and you can get rich. And by 2009, all these farm workers had left because these buildings were not worth anything, right? So I go to the broker and I say, how much does it cost to build this Kaufman and Broad house? And he says, probably cost $250. What are you selling them for? $90,000. And I'm like, but why doesn't everybody buy them for $90,000? Well, the answer is, his answer was, if you could rent them today, then you could buy an infinite number of them. The challenge is you can't rent them easily because there's also empty homes in Fresno, and Fresno is 20 minutes away, and that's the job center. So I learned something important about job centers. So I called the Ukrainian hacker, and I said, I want you to generate a very, very large number of leads for me for this property in Fresno. So I drive to Fresno, 20 miles away. I go buy a property on Summerfield Drive, and I basically say, I want 10,000 leads for this property, tenant leads. And the Ukrainian hacker is like, why? You only need one tenant. Why do you need 10,000 leads? I said, well, because I have an evil plan, and it involves a Philippine, a person in the Philippines. So I hired this lady in the Philippines. Her name's Julianne. And I tell Julianne, these people are going to call you because I have this home that's advertised. And when they call you, basically tell them that home is done. It's already rented. But I have a brand new 4-bedroom home in Madera, 21 miles away. And if you come see it, we will give you a $50 Amazon gift card. Nice. Right? $50 Amazon gift card. Roughly 90% of the people that would call her would hang up on her, thinking that she was running some kind of scam. But that 10th person would say, sure, $50, yes. And she would send him information about this beautiful property. And the moment this started happening and I started realizing people were accepting my $50 cards, I went to a bank, and that bank owned 700 of these Kaufman and Broad units. And I made a deal with the bank. I don't have money to pay you. If you let me show the property before you buy it, and I can get a rental contract signed, the same day I will pay you cash for the property. So I ended up owning entire streets of properties in Madeira, right, by simply renting them first, having cash flow, and then going and paying for them the next day, and then refinancing them the next month. And within a year and a half, I had completely replaced my income. And I had the big, fat tech income, right? And what was interesting is I enjoyed my job more than that after that. Because then I stopped working 13 hours a day. I would work 10 hours a day, and there was nothing my boss could do. He had observed this whole process. And I realized this stuff is incredibly powerful. It's life-changing. More people have to know about it. Also, my ego said, this cool stuff that I did, I want to tell 1,000 people about it. So I was like, I'm going to open a meetup inside my campus because I'm really lazy and I don't want to go to meetup in the evening in Bay Area traffic. So I ended up with 4 meetups running out of my campus in Fremont. We had large classrooms the size of this room. And so we'd have meetups. And I tried different meetups, and I couldn't get satisfaction because all of the meetups were different kinds of things, like Christina's meetup. I wanted a data science meetup. So I decided I'm going to open a data science of real estate meetup. And the first time I did it, there were 4 people, very nerdy people. 3 of them worked for Apple, 1 worked for Google. And these people showed up, and they really loved what I was doing. And I was like, maybe the next time 6 people show up. Like 10 people showed up. The 4th time I did it, there were 100 people in the room because I happened to be in the best place in America for geeks, nerds, and dorks to come together and enjoy real estate data science, right? So these people are all in a room, and they're really liking what I'm doing, and everyone's investing. Like, all these guys are investing like crazy using the data that I'm putting together. You know, we're all sharing it, like, because there's nothing to sell, right? I'm running a tech company, so people are coming up to me and say, can I invest with you? No, but you can take my data for free, right? So everyone's having a ball. They're all investing. Everyone's running around to all these different interesting cities in California and investing, and we're all having a ball. People were making millions. There was one guy who ended up making, like, he was from Apple, and he had a lot of Apple stock. He ended up making like $20 million using the system that we developed. Then somebody says, we should give this a name. So I called it Location Magic because people told me it has to have a nice and interesting name. Another guy says, why are you only doing meetups? There's only like 100 people listening to you. Why don't you stick it on the internet? And I'm like, where should I go? And he says, there's this website called Udemy. Put it on there. And I'm like, okay. So I work over Christmas. I design a video course, which is a Location Magic course. And I also simplify it because initially Location Magic was, you know, by data scientists for data scientists. And so, but people said, if you want other people to use this, you have to simplify it. So I basically set a goal for myself that anyone should be able to use Location Magic in 10 minutes. And it took me a year to figure out how people could do it in 10 minutes. And the second rule was it shouldn't cost them any money. They shouldn't have to buy any data. So anyone could say, I want to compare Nashville, Tennessee to Idaho Falls, Idaho, and know exactly how to do it in 10 minutes, right? It took a year to figure that out. I figured it out. I put it on the Udemy website, and I think maybe 50 or 100 people are going to show up. Currently, if you go to udemy.com/realfocus, there are 12,500 people taking the course. There's thousands of 5-star reviews. It's the most popular real estate course on the website, and we've never charged anything for it. There's no subscription. No one has to pay me. No one has to send me an email. Each year, I go and update the course because the data requires an annual refresh. So every year in January, I go refresh the course. You might say, how did this make me any money? Well, at that point, it didn't, because the goal really wasn't to make money. It was to learn and enjoy and share, right? That's gratitude. I was sharing because I was, for the first time, free. I was free in my life, and I wanted other people to know and enjoy the freedom that I had. And so we shared. But it did go somewhere because my phone started ringing. People were calling me from Orlando and from Dallas saying, hey, you're that geeky guy teaching real estate data science, right? We want you to come to our conference. And I'm like, but you realize I'm not a real estate guy. I don't have a company or anything. I'm just a guy running a tech company. And they're like, that's fine. Come, present. And so I'd go to present, and I was having a ball because these guys were giving me conference tickets and business class airline tickets and putting me up in hotels. And I'm like, wow. You know, and I felt like a total fraud because the people on the, on the stage were like, this guy has $1 billion portfolio and that guy has $1 billion portfolio. And then I would walk up and say, hello, I have no real estate portfolio. I just own a bunch of single family homes and here's what I'm doing. But people liked it. They really enjoyed what I was doing. And so I started gathering a database of people, right? People that liked what I was doing, built a newsletter and started working on it. None of this really was going anywhere. It was just very haphazard. There was no structure to it. We put it together and said, hey, here's a way to get involved. And we started building a presentation, and you'll see some slides from that presentation today. And people started getting more and more interested in this. So I expanded it all across the US. And we created a database of 323 metros. There's 323 metropolitan statistical areas in the United States that cover about 95% of our population, and we started measuring them. Location Magic measures them in 5 ways, right? And that's the course that's very popular. People are using it. At last count, we think that there's about 75,000 real estate investors that use Location Magic to compare cities. And today, we use over 200 metrics to track cities. And obviously, that takes a lot of money, and we spend money. In 2013, I sold my business, and within 6 months, I realized I was about to pay a massive amount of money in taxes. And so obviously, real estate seemed to make the most amount of sense. But even investing in real estate would not get rid of such a huge amount of taxes. So I realized that I could be a general partner. A GP gets a lot more tax savings for the same dollars that they invest in a project than an LP or a limited partner. So I became a GP. I had this list. I emailed people. They were waiting to invest with me because I'd been working with them for years and years. And it sort of developed from there. So today I have about almost 1,000 investors. They've given me $300 million of their money. And I've built or bought about $1 billion of real estate. And it's also led me to my life's work. I've built many different asset classes. I've built many kinds of apartments, high-rise, garden style. I've built student housing. I've bought old apartments. I've built townhomes for sales, townhomes for rental. I've done office. I've done industrial. I've done self-storage. All of them gave me a lot of satisfaction, but I eventually realized that I needed a mission because I'm a mission-driven person. I'm emotional in nature. I'm mission-driven. And so I realized that my mission had to be tied back to my tenants. And so I surveyed the tenants in all of my properties, and I learned something sad. In all of these wonderful apartments that I built, none of my tenants ever actually wanted to live there. They lived there because they had no choice. They lived there because they had no choice, right? That was their only choice. And they liked my apartments. They're new, they're nice. Everyone wanted to live in a home. But the problem is the American dream of having a home is utterly destroyed. Today, unless you make 6 figures, and in many metros, 6 figures don't work, you know that, this is one of those metros, you can't really live in your own home. And so my life's mission now is to build 10,000 townhomes, affordable townhomes, for middle Americans. I'm not interested in doing this in the San Francisco Bay Area or Los Angeles or New York. I'm building them in markets that you may not have even heard of. Greenville, South Carolina, Rogers, Arkansas, Shawnee, Kansas. These are middle American cities with families that make $60,000 to $80,000, which is considered good income in those areas. And until 10 years ago, all of those people would have bought their own homes. But now those homes cost 2.5 times more than they used to do in 2010. And so they don't have a choice. So my mission, which I call Mission 10K, is to build 10,000 townhomes. I started building them in 2019. By the end of next year, I will have 40 properties, 4,000 units in construction. Right now, they're all in pre-construction. It takes a while to get them to that point. And so that's my story. And today I'm here to talk about 4 very interesting trends that I've seen in real estate. All of you might know a little bit about these trends, but I think you'll see some very interesting aha moments as I go through them. Let's get started. There we go. And if this Bluetooth speaker works, I'm going to start with a video. Come on, come on. I swear this was working until 10 minutes ago. Let me just turn it off, turn it back on. I know. So one of the secrets that you should know is technology is just as annoying for technologists as it is for the rest of you.
All right, I'll just use this. There we go. All right, let's see if this works.
Joining us today, Carroll founder and CEO Patrick Carroll, whose company manages more than 33,000 multifamily units across the United States.
There's $1.5 trillion of debt maturing on commercial real estate and then by 2025. So sellers are not realizing how much their properties have lost value, and they're not willing to dump their properties yet because they haven't felt enough pain. They're about to start feeling pain. These lenders are spooked. There's no lending going on. There's no transactions going on. And it's going to be ugly. I mean, it's going to be at least as bad as 08, 09. People don't want to say that, but it's, downturns always are worse than the one before, and upturns are always better. I've rode the wave of price appreciation, rent growth, things like that since 2011. Well, the party's over, unfortunately. It's going to be okay in multifamily, but the office market is going to be destroyed. Hotels are going to be destroyed. It's going to be ugly.
When you start a presentation this way, the first question is, why did Christina invite this guy? Because this is the kind of message that he delivers. Here's the key thing that you should know about. Almost all opportunity lives in distress. The higher the distress, the higher the opportunity, right? If there's one thing that I wish for in real estate or in anything else that I do, is distress. You're very lucky because we are about to see a distress cycle. As he said, you heard him, multifamily is going to be okay. It's likely to be okay through this distress process. But there's many other asset classes that are going to suffer intensely in the coming 24 months. So we'll start the presentation with that. This is a really good group, so I'll just say, I'm not selling securities. Make sure that you talk to a financial advisor before you spend money. I'll skip past all of this stuff. I've already told you my story, right? So a couple of things that I wanted to start with, and this is my first trend, is inflation. You go to any meetup, everyone's talking about inflation, 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 inflation. That's not a trend. Do you know why? Because everyone knows. One of the key characteristics of trends are very few people know. So I'll give you the first trend of the night. That trend is disinflation. The last 18 months were time to worry about inflation because inflation was going up, and even when it was coming down, it was really high. Today, everyone needs to worry about disinflation. Yes, we've lived through double-digit inflation. By the way, there's a lot of people, we're politically so saturated that people for some reason think that we printed a lot of money and that led to inflation. Okay, how do you account for the fact that the entire world had high inflation, even though 80% of those countries did not print any money? If you look at the countries with the highest inflation, we're nowhere in that list. Inflation has happened not just because we printed money, but because of enormous supply chain disruption. So remember that, because if inflation was just a money printing problem, we would have only seen it in the US. But what's important to note is today inflation is down, right? So inflation peaked in, this is June 2022 at 9.1%. Today it's around 3%, and it's still declining. I am not worried about inflation at all today. I am worried about its effects, interest rates and things like that, but I'm worried about disinflation because here's what I'm seeing. Today, the Fed funds rate, the rate that the Fed controls, it was 0 since COVID started, and then it went all the way up. Today it's at 5.33. Yesterday, the Fed decided not to raise it further. They're keeping it where it is. But that's inflation, that's core inflation. Every single time when the Fed launches a campaign using the Fed funds rate to bring down inflation, and inflation cuts the Fed funds rate, there's a recession. 9 times since World War II, the Federal Reserve has gone after inflation. 8 times they've caused a recession. In fact, here's the funny thing. The Fed will never say this, but old Fed governors say it very candidly because they're no longer, Fed governors. The mechanism that the Federal Reserve uses to kill inflation is a recession. That is their mechanism. That's what they're trying to achieve. And that's what we should be worried about, because the manufacturing index,
And I know this is a weird slide, but what I want you to pay attention to is, you see these gray bars? Those are recessions. Big recession, short recession, very short recession. That's the COVID recession there, right? These gray bars. Every single time there's been a recession, the manufacturing index has been below 50. That's the 50 level, right? Every single time. The manufacturing index has been below 50 for 9 straight months. 9 straight months. It's actually lower. The current level is this, 46.4. 50 is equilibrium. Above 50 is growth. Below 50 is compression or recession. This level is below 9 of the 12 recessions that we've recorded since World War II. That's why I'm worried about disinflation. The supply chain disruption is causing inflation. Everyone tells me that. No, it's not. It was causing disruption, and now it's not. Oh, supplier delivery time, I can't get my washing machines and I can't get my appliances. Yes, that happened. Today's supplier times are below 0. You know what below 0 means? Too much supply. The labor market is too tight. Yes, but it's loosening, and this is by design. We had 11 million jobs open in the United States 5 months ago. Then we had 10. Then we had 9. Today that number is 8.8. The Fed is doing exactly what it's supposed to do, trying to kill that labor market. And by the way, to cause a recession, that number of 8.8 million doesn't have to drop to 0. By the time it gets to 6 million, we will be in a recession, because there's always some jobs open in the US, even during a recession. What about commodities? What about energy, metals, crop costs? Up, down. Demand is falling. And it's not just falling in the US. One of my favorite websites to look at trends is freightos.com, freightos.com. And on Freightos, I look at charts like this. To ship a container from the Chinese port of Shenzhen to our biggest port on this side, Long Beach, right, the Los Angeles port, a container costs roughly about $1,500 before COVID. And then up to $11,000 during the supply chain disruption, today down to $1,499. Now, that's still $1,500 here, so what's the big deal, Neal? Don't you realize that there's been 30% inflation during this time? So if it's $1,500 here, that's the equivalent of $1,050 here, right? Demand is cratering across the world, and that portends a recession. But understand this. I understand that people worry about recessions. You are trained to worry about recession, right? Thousands of podcasts and YouTube videos tell you recessions are bad. They're not bad for you, because you're here to look for opportunity. And opportunity exists in bad times. It accelerates in bad times. There's an uncle that I have in my family who now routinely F-bombs me for not convincing him in 2009 to buy properties. As it happens, he's the one that banned me from family events. All sorts of measures are cooling. So the number one thing that to look for, and your job, by the way, to stay ahead in real estate is to look ahead. Because if you look at today, you're always going to get the wrong information, right? ING says the drop in commodity prices seems to reflect stuttering rebound in China. By the way, if you don't know it, the top 3 problems in the world right now are China, China, and China. Okay, if you don't understand what I just said, you're not reading enough. Go figure out what's happening in China. They're having an extraordinary crisis, right? And it's going to result in severe problems for the world in the next 5 years. And then you've got demand destruction that's happening in Europe. And so the word that you're going to hear a lot more of in the next 6 months, I promise you, is this word, disinflation. And it's going to help you with your real estate adventures. Having said that, moving on to my second trend, single family. I live in the world of multifamily. I live in the world of built to rent. But the single family world is very fascinating right now. I track each year 21 different groups that forecast single family prices. and this was the beginning of the year. And so almost all of this is red, right? Almost everyone thought single-family prices would go down. John Burns, which is actually the most well-known consulting company in real estate, thought they would go down 20%. CoStar, the best-known multifamily data analytics company, 20%. And then there's these people who were ridiculously bullish, and 9 months ago I was laughing at them. I was making jokes about the NAR, which is basically a well-known mouthpiece of the Agents Association. As it turns out, the NAR was right. Home prices in the United States haven't dropped at all. Multifamily prices have dropped by 15 to 25%. Single family has been flat. Now, there are places in the United States where they're dropped. Some of you are thinking, no, he's wrong. I know that there's price drops, and I'll talk about that in just a moment. But nationwide, home prices haven't dropped in the last 12 months. And we learned the power of lock-in. There's only one reason why they haven't dropped. 85% of all mortgages in the United States are locked in below 5%. Today, mortgages are at 7.3%. So if somebody sells their home and moves to a new home, first they have to deal with higher property taxes, especially if they're moving in California, but now their new mortgage is 7.3%, which means that the single-family market is in a very unique place. We have a ridiculously low inventory compared to any time, compared to 2008, compared to 2001. Ridiculously low inventory. For the first time in history, the price of a new construction home is within $5,000 of an existing home. Usually the difference is $50,000 to $75,000. Why? Because there's no inventory of existing homes. There's no inventory, so their prices have gone up. And builders who have to sell brand new product are discounting it or giving rebates, or interest rate rebates. They call it an interest rate buy down, and their prices are coming down. So we have new construction homes and existing homes in the US in the same price gap. This shows you the power of lock-ins. Lock-ins mean that the single-family market has not dropped at all. Now, there are markets in the US, including ours, that have dropped the most. San Francisco, minus 13%. Sorry, hard to see. San Jose, minus 12.7%. For whatever reason, Oakland's not in this list, I'm not so sure, but it should be in this list, right? So you've got the super hot markets in the US. So Phoenix is 10.5% down, Austin's 9.7%, Vegas 9.3%, and I expect that these prices will continue to drop. Now, keep in mind, prices in the Bay Area currently are not dropping. That's because we're in the summer season, which is now ending, right? So it takes a while because properties are in contract, so it actually takes 2 or 3 months. But once winter season comes in, there's pretty much a guarantee at this point that the Bay Area prices will drop, and they will drop in every sub-market in the Bay Area. So all counties, and I track all 9 of them. I don't actually invest in the Bay Area, but since a lot of my investors live here in the San Francisco Bay Area, I track it. Los Angeles is in a very similar position. With the exception of Riverside, you should see home prices decline in all of the markets over winter time, and you might see a rebound sometime in spring next year. It's very important to understand, though, this isn't 2008. There's a lot of people that are saying that for single family, this is 2008. My feedback is it may be 2008 or worse for other asset classes. Single family actually is in the best, the most liquid position that I've seen it in a very long time, because even in 2016 or 15 or 17, you did not have 50 million homes that were refinanced at extremely low rates. And that only happened because of COVID and interest rates being, the Fed funds rate being at 0. The market is extraordinarily robust in the single family direction. And we can talk, you guys can ask me questions about where to invest in single family if you want. I'm going to move on to trend number 3, because here is real opportunity, and we're going to talk about that opportunity. The $500 billion, and actually it might be $1.2 trillion, real estate apocalypse might be happening. This might be far, far worse than 2008. Offices were 95% occupied before the pandemic. Today they're 57% occupied. Note that I'm not saying that they're 57% leased. they're actually 80% leased. They were about 90% leased. They're now 80% leased, but they're only 57% occupied. How do I know this? Because there's a company that sells key card data. You know those key cards that you swipe when people go into offices? And then there's a company that sells cell phone data. So both of those numbers are in the high 50s right now. And keep in mind, this data is very recent. I'm not talking about 6 months or 12 months ago when companies were still calling people back. I think companies are done calling people back. The ones that wanted to enforce it have enforced it in the last 3 or 4 months. People are back. But this is the new reality. The companies that were allowing 1 day a week before COVID are now allowing 2 or 3. The companies that were allowing 2 days a week are now allowing 3 or 4. So this is catastrophic for the asset class that was actually the largest asset class before multifamily took over in 2005. Office was the largest asset class. Morgan Stanley says we estimate office and retail property valuations, notice not just office, retail, could fall as much as 40% from peak to trough, increasing the risk of defaults. Single family in the 2008 crash dropped 29%. Now there are markets that for some pockets during some times dropped as much as 60%, including Madera, California, which dropped the most of all markets in the United States at 69%. But that was a time, there was a window, and then prices changed again. Overall, there was a 29% drop. That 40% is a much larger number than 29%. And you might think, this isn't really happening. Well, I live in San Francisco Bay Area, and this is actually a pretty famous building. It's on California and Market, right? This is the Wells Fargo Tower. This tower its value was $1,000 a square foot in 2019. This tower was just sold for $200 a square foot. At 80%, this is the biggest disaster in US real estate history. We haven't had an asset, a core asset, in a core market sell at 80% discount. And you might think, he's just picking a one-off thing. He's just, picking the worst example. Diagonally opposite is the Union Bank building, which just sold for a 75% discount. So in San Francisco, a new bar has been set, and it's been set at a 75% from 2019 discount level, now that there's 2 comps, which means that all offices in the entire city of San Francisco are illiquid. No one can sell, and no one can refinance. This is now spreading to places like New York and Seattle and Boston, and is going to spread to Los Angeles as well. It's also spreading to other asset classes. These 2 hotels, the Park 55 and the Hilton San Francisco Union Square, are both Park hotels. They're both in default, $727 million, because they were serving the offices that are now empty. And this is my wife's favorite mall. This is the Westfield San Francisco. She's devastated that the mall's $558 million mortgage, it defaulted, and as soon as it defaulted, Nordstrom closed down, my wife's favorite store. So she's not going here anymore. So this is now cascading because offices were the bedrock of downtowns. And when you take the bedrock away, all of the other things that are dependent on them start to fall as well. Refinancing risk is key, and that's what these folks are pointing out. Morgan Stanley again pointing out that these cannot be refinanced, because for refinancing you need a certain value, and if your value is down even 30 or 40%, there's no refinancing. They're also pointing out that mid-sized banks of the Silicon Valley Bank kind, of the First Republic kind, they're holding 80% of these real estate assets. If the assets were being held by Wells Fargo or Bank of America, that's fine. But what if they're held by smaller banks? Doesn't that imperil the banks themselves? It does. In fact, 46% of all retail in the United States is held by local and regional banks. 31 for industrial, 30 for office, 37 for hotel. Very little for apartments. Anyone tell me why this number is so low, only for apartments? Anyone? Any guesses? Yes, you have it, right? There are 3, not 1, not 2, but 3 government organizations whose job it is to lend to multifamily. There are no such government organization
for any of these other asset classes. And they're called Fannie Mae, Freddie Mac, and HUD. Those three allow multifamily to be completely liquid. Right now, I can get a loan on any of my properties through those three. But we will come to a time in 2024 that lending will stop for some of these asset classes. I don't know how long, and I don't know if it'll continue, if it'll happen in every single market, but we're getting there. My best guess is we're 6 or 7 months away. All right? And we're already seeing the impact on the stock market. So the real estate investment trust market, hold your question, we'll take them at the end. The REIT market, where basically people aggregate these properties, so there's office REITs, and then there's multifamily REITs, there's industrial REITs, down more than 50% already. I expect this to continue, and I expect those numbers to go down even further. There's a lot of people, this is very common, but Neal, we're just going to take all these office buildings and convert them into apartments, and that's going to save us all. That's a nonsensical idea. Only 3% of office buildings can be successfully converted. The biggest reason is simply this. So I'm going to use Christina's laptop. So here's an office building. This is the floor plate, horizontal floor plate. Well, the law requires that every apartment, every room have its own window. So you can only convert this, but you have to buy this. How the heck do you make the numbers work? So the only kind of office buildings that can be converted are the thin ones, the narrow ones. That's it. Most office floor plates will not work, because what are you going to do in the middle? Create a pickleball court? Create a pickleball court. There you go. I didn't think of that. Bottom line is this. You might think that my bottom line is that office is a tainted asset class. I am not trying to point out to that. I'm trying to tell you this, and I'm going to skip past some of these. I'm trying to tell you this. Whoop, I'm going to go past this as well. I got a lot of content here. Trend number 3 is different from what you think. Office, screwed. Please don't buy office for any reason at any price, because they don't have a plan B. This is a systemic problem. And some of you that have gray hair remember that Los Angeles has been through this problem with its downtown, and it took a very, very long time to fix. Here is the bottom line. Here's the mega trend. For the next 10 years, downtowns in most parts of the United States are going to be blighted, because the bedrock, the taxes were coming from the office market, and that market is devastated. And it's just beginning. You haven't heard of this, right? The only reason you haven't heard of this is because office leases are 5 and 10 years long. And a lot of the people they're signing these leases, these companies have money. So they're waiting until their leases end. But renewal rates are catastrophically low. They're not renewing at all. They're very, very low. And if they're renewing, they're taking 1/3 of the space that they used to have, because of the way that the work culture has changed. So don't buy anything close to an office core or a downtown core in any part of the US, especially not in California, because the prices here were the most out of whack. That's my trend number 3. Please remember that. This is not one that has opportunity. I'm about to give you opportunity, but this is a wipeout. However, the key opportunity is this. There's very high quality asset classes like hotels. You think about hotels, they came out of this COVID crash, or obviously they were empty. And they came out, and their average daily rate, or ADR, that's how we measure hotels and their health, have spiked. They're doing really well. They have a very high level of occupancy right now. Hotels are doing phenomenally well when it comes to income or net operating profit. But because of what is about to happen in the next 12 months, they won't be able to get financed easily. So the greatest opportunity is that you can pick up retail and you can pick up hotels in the next 12 months. Just the people in this room, if you get together, you have the ability to go out and buy hotels. Now you might say, I don't know anything about hotels. I don't know anything about hotels either. I'm still going to be buying them.
You find the right people to manage them, right? We are investors. We're not hotel operators. 90% of the people that own hotels in the United States are not operators, they're investors. They hire operators who are widely available for hotel assets and retail assets. Now, a lot of you are afraid of retail because of the whole Amazon effect. I was too. The more I dig in, the more I realize what really has happened in the retail market is that they haven't built anything in the last 5-6 years. When you look at the total number of retail units or square footage that's been created in the last 6 years, it's nothing compared to what used to be created. So the Amazon effect has actually led to a decline in retail building. Do you know today, retail vacancies are the lowest in history. They're between 3 and 4%. But retail prices are low and they're about to get a lot lower. Remember, in the next 12 months, financing retail is going to become difficult. And you might say, if I buy, I'm going to have that trouble. Yes, that's going to be your catch. But I think that there are many, 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 many ways to get around that. I think hotel and retails are an incredible opportunity. Now you might say, why aren't you doing those, Neal? The answer is, firstly, I'm waiting. And second, my mission is Mission 10,000. I don't want to move away from my mission. I'm very happy with it. But there are many friends of mine that are looking at it, and if I get a chance, I'll deploy money. I might deploy $50 or $100 million of my investor money with them. That's the opportunity. Hotel and retail are going to basically get rammed under in the next 12 months when it's really the office fault. And there's huge opportunity in these asset classes. I predict that you'll be able to get retail assets at more than 50, possibly even 60% off within the next 7 or 8 months. Not because their income is down, but because of financing. Huge opportunity.
All right, I'm going to finish off with number 4, is distress coming from multifamily. Now, these are my projects. I'm going to skip past these two and just tell you about this one. Mission 10K. This is a townhome that I built. Not just one townhome, these are 4. And in cities around the United States, I'm finding cheap land. I'm paying 30% of what I was paying 2 years ago, because land is the asset class that becomes illiquid the fastest during a time when rates go up. So today, 24 months ago, when I wanted to buy land, for example, for this property, because this is a picture of a real property that I own, I had to close in 60 days, and I had to provide $200,000 hard on day one. Do you know what I'm doing today? Today, I'm not going hard for 6 months, so there's basically no hard deposit for 6 months. My deposit is 2% of the purchase price, and the purchase price is already 70% discount. So a $4 million property where I had to come up with $250,000 hard on day one, here's a contract, and by the way, anyone who wants proof of this, it's on my laptop. Come to me and I'll show it to you. I'm buying that piece of land for $1 million. My deposit is $20,000. It doesn't go hard for 6 months, and then I have 12 more months for free, and I don't buy the land if the city says anything about it. So for 18 months, all I'm putting up on a piece of land that used to be $4 million is $20,000, and it's refundable for 18 months. Currently, I have 5 full-time employees. By the beginning of next year, I will have easily $400 to $500 million worth of land in contract. Distress is opportunity. Opportunity is distress. Let's look at multifamily and end with that. I'll go through this fairly quickly.
Over 30% of all properties purchased by syndicators using floating debt in 2020, 2021, and 2022 are now bleeding cash. The number will be 40% on July 1st.
Multifamily was the asset class that went completely crazy in late 2021 until mid or late 2022, right? So, late 2020 to late 2022. So that's about 2 years, maybe 7 quarters. And during that time, people paid crazy amount for properties. I had students, I used to teach multifamily boot camps, 4-day boot camps. And I had students who bought 10 properties in a single year. And each property was $40 or $50 million. So they bought $400 to $500 million worth of properties. And I bought one, and even that one, I was terrified that I was buying that one. And that one is giving me trouble, just so you know, I wish I hadn't bought that one. But I wanted to buy something because I felt this FOMO, fear of missing out, right? Data scientists feel it too, by the way. So, we are emotional and we do things. And I bought one because my students were buying 10. But 40 to 50% of those properties can no longer be financed. Now, a lot of people think that this is the end of multifamily, this is 2008. It's nothing of the sort. So the first thing I want to say is, this isn't 2008 in multifamily because the demand is extremely high. There are a total of 105,000 multifamily large properties in the United States, apartments. Of them, 2,500 are going to be in distress. That's 2.5% of the total stock. Yes? Everyone get that? Now, let's focus on this 2,500 properties. At $30 million each, there's $75 billion worth of properties that cannot be refinanced, especially because of what the Fed did yesterday. They changed the dot plot. The moment the Fed changes its dot plot, treasuries go up. So they've been spiking. They're now at 4.5, which essentially means that even some of the properties that could refinance because their performance was good, they cannot refinance anymore. As of 2 weeks ago, the discounts in multifamily have crossed 25%. This isn't public knowledge because even 6 months ago, the discount was only 10%. Multifamily was doing well. There's huge amounts of financing available. Remember, multifamily has government lenders. No financing issues at all, but the amount of financing is the problem. Banks are not willing to finance to the level that they were before. So as a result, you're going to see distress in the multifamily space. I'm actually busy with Mission 10K. Otherwise, I'd be buying properties like crazy next year. Multifamily is really the easiest asset class for you guys to look into, other than single family, right? Because the challenge with single family right now is there's no distress in it. It's a robust market. There's opportunity, especially outside California. I'm not so sure about California, but there's a lot of opportunity in single family there. Multifamily is where the distress is. Bottom line, you are going to see massive headlines in the next 12 months about multifamily discounts. I think that the discounts might go into the 30s in certain markets like Phoenix, Atlanta, Dallas. Dallas is already above 25% in discounts, and you might see discounts in the 30% range. Here's the key thing to remember, right? When home prices were falling in 2008, nobody knew what the bottom was. Here's the cool thing. There is no evidence that net operating income of these multifamily properties is dropping. None at all. So you have an asset that has the same income as it used to have 2 years ago, but its price is now 35% lower. Well, right now it's 25, but it'll get to 35. That's what I'm predicting. That is awesome. If you're an economics student, you might scratch your head going, how is it possible that this thing has the same income, or in many cases a higher income, and I'm getting a 30 to 35% discount? Well, the answer is the way the banks underwrite them, right? The property is not producing sufficient income to be worth more money. Therefore, the price drops. The bank says, this property can only support this much of a loan. I'm not going to give you more of a loan. Well, if they're not going to give you more of a loan, then you can't really go buy a property because no one has $30 million of cash sitting around in their pockets, so the value starts to fall. And that's why we're seeing an incredible level of opportunity. It's still early days. There's many of you in this room that are limited partners in multifamily syndications. Raise your hands if you are. All of your properties, if they were purchased in the last 3 years, are in troubles. Your syndicators haven't told you. It's the truth. It's the truth. Here's the message that I have for everyone that raised their hands. 99% of you right now will not invest in multifamily. Do you know why? Because some of you are now aware that those properties are in trouble, right? Has anyone had a cash call? Anyone? All right, so some cash calls, right? This is the beginning of the cash call process. It takes a while to get there. So whoever does a cash call, then he's like, I'm not going to invest in multifamily because my multifamilies didn't do well. If you're thinking like that, and the truth is every one of you that raised your hand is going to think like that, you're not an investor. You're just a speculator. You follow the horde. If you have had
a problem before, you equate it to a problem in the future, and so you miss out on opportunity. Yes, somehow, and I'll pick on you, sir, sorry. You're old enough to take it. Somehow art was okay with investing in this property at 4 cap, which by the way is a very high price, 2 years ago. Today that property is available at 5.5 cap, a much more reasonable price. But he's afraid because the 4 cap property did poorly. So he thinks the 5.5 cap property will also do poorly. And so now we have investors who are basically frozen because they're looking at the past. Your job as an investor is to look into the future. And so the opportunity on the multifamily side is absolutely incredible. I may not be able to monetize it fully because of Mission 10K, but I hope that you guys are able to monetize it. That's the message I had for you. Thank you for your time.
What could you say about the difference between what's going to happen in office or what's happening in office in the downtowns versus in the suburbs? Let's just even talk about like Class A, Class B suburbs.
Very good point. So a lot of those suburban offices are actually doing better because people want to come into the satellite offices. So the office apocalypse as a asset class is massive, but there are going to be certain parts that are going to do well. Suburban offices are doing better and their occupancy is higher. What my answer for you is, Mayor, this is a time to buy data. There's a company called CoStar that has very good data. If you're buying offices, you really need to understand office as an asset class. They have incredible data. Just pay for it.
2 questions, if I may. I'm sure you're well aware that in March, the regional bank issues had to do with liquidity runs due to a lot of tech firms needing
Yes.
cash, and the whole issue of like held to maturity,
Yes.
assets for treasuries. Are commercial real estate loans also subject to that whole like HTM, like kick the can down the road, or are they also subject to mark to market?
Both. So bottom line is what happened to Silicon Valley Bank was because there was a trigger. There was a maturity that was coming up. And if that maturity hadn't come up for 2 or 3 years, Silicon Valley Bank would still be here today, right? So it was a trigger that was the issue, timing. Is that timing still there for commercial loans? The answer is yes, because the loans come up for renewal. The massive majority of them, 1.2 trillion, come up for renewal in the next 13 months, and they cannot be refinanced. So some of the properties that are doing fairly well, the banks will kick the can down the road, maybe even as much as 50%. Well, the remaining 50% is $700 billion.
No, my point is, so you got a commercial loan out at 3%, whatever interest rates have increased,
Right.
or the carrying value, the mark-to-market value of those loans on the bank's balance sheet now is significantly lower.
Yes.
But if they're treated as held to maturity, then there's no mark-to-market.
You can't do that. And the Fed is forcing mark-to-market on mid-sized banks. Remember, the Federal Reserve is forcing mark-to-market on all banks below 250 billion. And banks have a certain amount of time to mark their assets to market. So what you're talking about is something that banks would love to do, but they don't have that choice.
So my second part has to do with this one. How many, I'm starting to hear about more and more law modifications,
Yes.
extensions, and so forth. I mean, that's still a card.
It is a card.
played by the banks?
It's being played by the banks, but I think that works for about half the assets. If the bank knows that the property has really no chance of survival, they won't extend it, right? If the bank thinks that there's maybe a way for it to work out, then they're trying extensions. So about half, maybe even 60% of the assets, you can kick the can down the road. But if the bank knows that there's now zero equity left in this property, that makes no sense for them. Yeah.
You said something happened yesterday that changed the banks from refinancing on multifamily. What was that thing that happened?
The Federal Reserve, at each meeting that they have, publishes a dot plot, which basically shows their opinion of how the interest rates are going to go down. The Fed dot plot until yesterday was like this, and that was great. The market was happy with it. Now the Fed dot plot is like this. They're showing a decline over a much longer time, and that means treasuries go up. When treasuries go up, interest rate goes up, and this entire crisis, multifamily, commercial, the crisis becomes a lot worse. I was really hopeful that the Fed wouldn't do that, but they did.
I want to talk about the financing of multifamily. the existing operators can't refinance because the rates are going to be higher. How are new investors going to go in and refinance?
Because they're getting a lower value.
Lower value, but
Yes.
the rates are still going to be higher.
Sure, but there's no problem. Today, if you have a property, Mathia, at $50 million,
Right.
and you have a certain loan on them, let's call it $35 million.
Right.
Well, you can't finance that today at all, right? But what if you sell this property for $35 million and you have a loan for $20 million? The property's income is the same. It's got the same income, and now it has to finance a $20 million loan, not a $35 million. Where's the problem? The new operators don't have a problem, the old ones do.
So you do or don't recommend buying retail in downtowns? Or you recommend buying retail out of downtown?
Yes, yes. Look, there's a lot of places that retail is. It's just an amazing asset class right now. Low vacancy, and high cap rates. High cap rates means you're getting a low price. Why go into downtown? Stay away from downtowns, my friend.
Yeah. And if you were to do conversions, what would you recommend as the best?
Conversion from what to what?
Tell me.
Well, the best kind of conversion generally is from hotel to apartments, and I'll tell you why. Plumbing. Plumbing is extraordinarily expensive. Hotels are already plumbed, right? So if you can basically take a distressed hotel and you can convert it to small condos, or they don't even have to be condos, small rental units, well, at least you don't have to deal with the plumbing because they all have bathrooms, right? The hardest conversion is office to apartments, because every office, the bathroom core is in the corner somewhere, and you have to cut across the concrete and bring all of that plumbing to every unit. That cost doesn't work. Only 3% of the time it works.
Co-living for office?
Maybe, but again, you've got the same plumbing issue, right? Co-living still requires plumbing in every unit. No, thank you. No.
So jumping off of Matthew's question around downtowns, should we, if we're looking for multifamily, should we also avoid downtown or the areas immediately surrounding downtowns?
Absolutely. I think that there is no one knows how to price any asset in a downtown today if they're really commercial companies, but this is not public news yet, right? I get paid $1,000 an hour to consult with Wall Street companies, because when they go out and they buy, they're shorting a stock for $100 million, right? Part of their checkbox is they have to basically interview a subject matter expert. Whether they get any value from me or not, I don't know, but they do it because they're about to spend $100 million to short a stock, right? So a bank, I won't mention their name, is about to short one of the biggest banks, and this is the bank that lost a $229 million asset in Houston, if you remember that asset. Many of you have heard about that asset. Well, they're about to short them. So they pay me $1,000 an hour, and I'm talking to these people. They're well aware this is about to happen, but I haven't seen it in the media just yet. There's some talk in the media about it. The people don't fully understand this. So to me, there's just not enough general market understanding of the trouble. So the prices really haven't dropped in any asset class. Hopefully that answers your question.
Yes.
Maybe. Okay. Two more questions.
Do you think unemployment will actually have a ripple effect, contagion?
Oh, no, I don't think there's contagion. The U.S. economy is very strong. So, after 15 months of beating the crap out of the economy, the Fed has managed to take us from 3.5% unemployment to 3.8% unemployment. And most of that was basically more people returning to the workforce. So the U.S. economy is far too strong at this point for contagion. I'm not talking about contagion. Now, you'll hear about contagion because that's how YouTube videos get views.
Are we going to see a wave of REO properties and multis going back to banks?
Yes, for multifamily.
Opportunity there.
A lot of opportunity, yes. Probably closer to the end of 2024, yes, but not for single family.
Yeah, they hid that in 2010, 2012. There was no deals. You couldn't go to banks and get, them to really, open up to you about their REO. Is that going to change this time?
No, they're going to hide it. It's to their benefit. Well, okay, one more question and then we really have to go. So, David, you're the last question.
What's your thought on senior housing and any opportunities there?
I think there's a lot of opportunity in senior housing. It's a great asset class. You have to figure out, you have to be able to finance it. So my feedback is this.
This is not a time to be a first-time investor in those kinds of asset classes. Multifamily is the best known asset class out there, so it's fine. In those asset classes, you need to partner with someone who's done it many times before, because those are the only people that are going to get loans as this crisis starts to roll. All right? Thank you.
Thank you.
Thank you, everyone.
Good job, Neal.
Good job.